The rally that began from that March 8th low, it's what we call a bear market rally, counter trend rally. In other words, we broke so much long-term momentum trend structures back in January for the NASDAQ 100 and February for the S&P 500 that the rally that came from the March low didn't negate that. It was just a counter trend rally. You don't have a trend. It's very rare to have a trend that goes from Z to A or A to Z without zigzags. Expect it. In fact, all the bear markets in U.S. stock market history have had major rallies during the bear market. The kind of rallies that turn your head and make you think, oh boy, I should have bought the dip. No. And there's other markets to watch too. And we think they're important. One of the reasons we think they're important is the real culprit under all this are the central banks. They destroy the value of their money. They've done it for decades and decades. That's their job, to falsely price certain asset categories so that people feel good. The economy does well. Every decade, M2 money supply, basically since 1959 to 2020, doubled every decade, the quantity of money in the system. Well, I mean, that has an effect on pricing, but if the pricing doesn't always flow everywhere, the river flow of liquidity is driven by asset managers and investors. They put that river flow where they want to put it. And their preference happened to be, over the last dozen years, the stock market. So the inflation, the monetary inflation that the central banks created, went into the stock markets. In fact, in the case of the BOJ, Bank of Japan, they were long ago a major buyer of their stock market. They own tons of ETFs and huge percentages of the ETFs. And the Federal Reserve started that in May and June of 2020. April and May of 2020, started buying such ETFs as high yield corporate debt ETFs. Like there's one called HYG, one called JNK. These are private company, high yield, what you call junk debt ETFs. The central bank bought them outright, put them on their balance sheet. They also bought muni bonds and muni bond ETFs. There's an ETF you can watch there called MUB. If you go back and look at a price chart of these asset categories, which move in sympathy with the stock market, by the way, except recently they've let it down. They peaked when the Fed ceased buying the high yield corporate debt ETFs in June of 2021. That's when these ETFs peaked. They didn't fall apart, but they started to roll over. Fed wasn't buying them anymore. S&P continued up through December of 2021. So there's about a 6-month difference there where the ETFs, the high yield corporate and the muni bonds started to roll over, and S&P crawled up a little bit more. Then the S&P broke. Now all those categories are dropping. What's the significance of that to gold? These are asset categories that the Fed deems to be important, that they don't want to see go down, especially hard. Because if these asset categories go down, then your local governments are going to have trouble financing themselves. Corporations are going to have problems with their debt. That's going to cause unemployment problems. So all the good numbers you're seeing now will go away. And these markets, the behavior of these particular markets that are in sync with the S&P will generate the sort of economic data points that the Fed can then point at and say, oops, too much tightening. So they can speak as aggressively as they want to right now, and people tend to believe it. But there's a point at which these markets will generate not just declines in the prices of those markets, but in public sentiment, in corporate policy, hiring, etc. So watch those markets, because as those events start to unfold piecemeal, what is that going to do to gold? It's going to indicate that the central banks have no choice, and I'm not talking just the Fed, I'm talking the ECB and the BOJ, have no choice but to go full throttle monetary inflation again. Otherwise, their bubbles are going to break, and they're going to end up not with a recession, but a depression. They'll probably end up with that anyway. But watch those markets, because that's the kind of stuff that will cause the Fed to do another about face. And of course, what's going to happen if the Fed changes their policy sometime 3 or 4 months from now? Suddenly, no more half-point increases, but no increase this month. Surprise. It's going to signal to gold that, it is the alternative asset category that asset managers and investors are buying to protect themselves from inflation. They're divesting themselves of these other markets. And that's why it's important for gold. The dollar index, we have abandoned analysis of the dollar index. We finally decided that fundamentally it's a joke. I'll tell you why. First off, dollar does not influence gold. It has not influenced it since 2015. If you'll go back on a chart and see where the dollar was rallying, in fact, MSA was bullish on the dollar in the 70 area, and we thought it would go to 100. It did. In 2015, it got up to 100. Okay, actually got to 103 in late 2016. But if you look at it carefully over a 40-year period or 50-year period of the dollar index, it's been at about a 12% range, one of its narrowest price ranges in history of the dollar index. And right now, it is about 1 point or so above where it closed out December of 2015. December 2015, the dollar index was 98.65. Right now, it's trading in the upper 99s, okay? That's 5, 6, now going into 7 years, and it's up 1 point, and it's in an extremely unvolatile, narrow, meaningless range. Gold doubled during that time. Gold went from 1,040 something to 2,070 without the dollar doing anything but going sideways. So people who are looking at the dollar index, that is, are looking at the wrong place.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
I have bad news for you. If you're not rich by now, you're screwed. And if you're in debt, you're even double screwed. How so, you might wonder? Well, the sad truth is that you're working your whole life to make someone else rich. The mega corporations, the banks, the politicians, everyone is getting richer. They get your money. And what is even worse, they get your time, they get your life. You are not even in a rat race, you're in a financial prison. But what could a solution for you look like? Honestly, I don't know, but I know what a solution for me would look like. It's very simple. I use whatever money I have and I multiply it with 1,000. This could make my life much easier and probably yours as well. If you have $1,000 available and multiply this with 1,000, I believe that this could solve some financial issue for the one or the other. Of course, if you're ugly, you would have to multiply it with much more than 1,000. My name is Marco Stan, and this is what I decided to do. I decided to 1000x my money. This is not a joke. I know what you may be thinking. What is this guy talking about? How should this work? This is not possible. Well, I made a detailed video where I laid out my plan. And some clever folks might even want to look at this plan and copy it and do exactly what I do. This is just a little hint on the side. You have two options. You leave, you forget what you have seen. You do whatever you're doing and you hope that somehow you get some other results. Good luck with that. Or you click the link below the video. You enter your email address because I'm not showing this to everybody. You at least watch my video on how I plan to 1000x my money. The choice is yours. Make the right choice. Join me. See what a different future you could have. See at least how I intend, how I plan to do the 1000x. So click on the link below, enter your email address, and I see you on the other side. Your Marco Stan.